Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, HELMSLEY-SPEAR, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moinian Group.
Hello, my name is Michael Stoller. There allegedly, and I say allegedly, there is money out there from banks to lend. So I've assembled select banks from around mostly the New York area and one from Chicago, Illinois, together today to tell us what they're doing about lending and what's happening in this critical time in our economy. My guests today include Gino Martocci, Senior Vice President in charge of real estate lending for M&T Bank in the New York City and Westchester, no, Long Island area. David Bagatelle, the new kid on the block, the President and CEO of Herald National Bank, who opened up in November. Greg Fierce, Executive Vice President at the Amalgamated Bank, America's Union Bank. Kermit Dyke, Senior First Vice President at Valley National Bank. And last but not least, flying in this today from Chicago, Illinois, Rick Schuler, President and CEO of First Bank and Trust of Illinois. So since you came here from Chicago, you know, the Windy City, what do you see? What are you doing? Is there money out there? Are you lending? What do you like? What don't you like doing?
You know, there is money out there, and we are lending. But as I think we've all discussed, underwriting standards have clearly tightened up. But that's a good thing, because lending standards had loosened up to the point where it was not healthy for the system. Selfishly, it's good for us because we can do better loans with tighter terms and better pricing. Where we thought loans should have been done 2 or 3 years ago, we can do them now. It is admittedly very treacherous because real estate values are declining and the economy continues to decline. And so it is very difficult to determine values of collateral. But that said, net, I think it's actually a good time to be doing new lending because of the competitive nature.
So that relates perfectly to David. David, you're the new kid on the block. I mean, you and I go back many years from your M&T days and then the time at Signature. Now, you're the president and CEO of Herald National Bank. You started like just near Thanksgiving. You raised about $85 million over there, and I know you have another raise over there. So how does a new bank who's just started in business look at this market? And what are you lending on? What do you like? What do you dislike?
Well, first of all, as you know, Michael, we're a new bank in name only because the kind of people we're hiring have 20, 30, 40 years experience. In fact, just this week we brought over 2 new teams, both of which have 40 years of experience here in the New York marketplace. So the relationship bankers that we're hiring have tons of experience, so they're not new in the New York marketplace. We obviously, we have a lot of capital. We have money to lend. We don't have any toxic assets that some of our competitors have. With all that being,
Fortunately, I didn't put, none of these guys have toxic assets over here either.
I'm not commenting on any of our competitors, who they are. I think they know who they are, right, Michael?
Right.
But with that being said, certainly, and we're going to talk, I'm sure, about it, the economic situation is tough. It's treacherous out there. You have to be cautious. With that being said, we think there are a lot of good small and mid-sized businesses here in the New York metropolitan area, and we stand ready to really take the shoes of a lot of our larger competitors who are not out there lending. And that means we go out there on a relationship basis. We want their deposits, we want their loans, we want their cash management services, and we want their private banking as well.
You know, but on this situation, you know, we have Valley over here. Kermit, it's a $14.5 billion bank,
right?
Established in 1923 and 1927. And then we have Gino with M&T, who's close to
almost $70 billion.
$70 billion bank. You guys still lend. You were lending last year. You continue to lend. And I think Kermit said prior to the show, or David, both of you said that loans to commerce and industry was up in the fourth quarter, surprisingly. So how do you feel comfortable when somebody comes in to talk to you about a new loan?
Well, I mean, we clearly have increased our underwriting standards as well. I mean, we're in a recession. You don't loosen up your standards during a recession, so you tighten up what what you're doing. We do have money to lend. We're very well capitalized, very strongly capitalized. And we're out looking for full relationships, as you are. Good model, by the way. We've used that model for a while, and you know, we're in the business to make loans. Are our standards higher? Absolutely, but the times call for it. But our loans are up. Our resi mortgage business is going like crazy. There's a refi boom going on right now, so our resi mortgage business is quite strong. Our auto loan business is down. All right, nobody's buying cars. Nobody's borrowing to buy cars. You know, our C&I loans are up. Our commercial and real estate loans are up. We're in business. We continue to be in business, but we're being very cautious.
Gino.
You know, we continue to grow our assets. I mean, we're doing it very selectively. A transactional business, sort of the guy off the street, that business is gone. It's all relationship oriented. It's people we've done business with for a very long time. And you know, we mentioned this earlier. It's very difficult, and when you talk about underwriting standards, it's very difficult to underwrite vacancy today. It's just hard to know what the rollover is going to be. It's hard to know what rents are going to come in at, and that's whether it's office or whether it's residential. It's very difficult. And
like Gino and Dave, you know, we're very much relationship lenders. We've never been a transaction bank. We've always been in it for the relationship, to look for all the other things, and that's what we continue to do now.
So what about our friends at the America's Labor Bank, started in 1923 by Sidney Hellman, you know, putting a deposit, a great organization. I've known many of your presidents over the years. What are you guys doing these days?
Well, I think it, you know, you've hit it. We're a bank that has a pretty diverse portfolio of lending products. We clearly, you know, we're not created as a real estate lending bank. However, over the years, our union clients, our C&I clients, and my team was retained at the bank in 2007 to grow the real estate business. So in 04, 05, 06, we missed the train, so to speak. And we were lucky.
Maybe it was good.
Yeah,
well, it might have been good.
Regard,
you know, sometimes it's better not to catch that train.
The train left the station without us. So we got there in 07. We staffed up. We had plenty of capital. We were ready to go. And we saw things beginning to unwind. So we creeped into various businesses and various lending opportunities. So now we have plenty of capital. We're staffed up. We don't have toxic assets, not by any level of expertise, but sort of by default. And now we're ready to go. And so I put myself in the category of a relationship banker, and we're a relationship bank. And when opportunities present themselves, we're ready to jump on it.
It's interesting. You know, Valley is regional, basically New York and New Jersey. M&T happens to be national in a very
really Buffalo down to D.C.
Right,
so.
Buffalo to D.C. But you know, the domain is, and that's where you'll be staying in your market. Harold is going to be staying basically in your regional market. I was saying, you have offices in Chicago,
Not Chicago,
Washington, D.C., and Las Vegas and Los Angeles, correct?
Yes. Yeah.
So how do you look
New
at,
Jersey.
and then I'm going to get to Rick because, you know, he lends around the country. How do you look at the other markets? I mean, we know what's happening here. How treacherous is it to lend in these other cities?
Well, it's difficult, you know, and you basically have to resort to fundamentals. And, you know, there are certain marketplaces that, you know, right now you just wouldn't touch. But it's difficult to have a national lending business right now. You really, and, you know, we have a national lending business, but it's home-based. So you take the tri-state area and you move outward. And, you know, we're not too far from that center. But it is quite difficult. And you pick your spots, you follow your customers, and you just have a conservative lending approach to...
Vegas is you know, one of the toughest markets in today's things. Los Angeles is mixed emotion. But that relates to you. You're a company based in Palatine, Illinois, and you're lending around the country, coast to coast.
Yes, we are.
Okay, so how do you lend across the country? I mean, I know that you've had a great track record and you continue, because I think you were saying prior to the show, you don't lend on loan to value. You loan on debt service, debt coverage, debt yield coverage, or something more in that vein.
Well, the biggest challenge is certainly in the markets that went boom to bust, if you will. The faster it went up and the higher it went up, the more it can fall. And part of the difficulty is in a market with businesses or property owners, when they don't recognize the change, it's hard to lend to them. But you hear in the press that there's no lending going on. There's a big gap between doing no lending and doing lending that's too aggressive. We're simply building in bigger cushions so that we have more room for values and cash flow to decline before we get hurt. As I like to tell customers and other banks, we rent money. You know, it's really pretty basic, and we expect it back. And to do that, it has to be conservative terms and fairly priced money. But that doesn't mean we have to pull back completely and not lend at all. Banks, as a group, are guilty of being lemmings. We follow each other to extremes.
So you know, let's look at conservatism, what you're basically saying. David's average banker on his 16 teams probably has 25 to 30 years of experience, minimum over there. At least. You know, so when you're looking at a deal today, and we all have to be conservative because we're realistic that we're in a recession. We don't know really how bottom is over there. How do you look at a deal? I mean, people in certain aspects, unfortunately, people who are borrowers know who's lending money. They're very smart. They smell this. Okay, the brokers, there are other people there. How do you get comfortable to know what's really good and what's tough? I mean,
well, I think first of all, it's know your customer. You know, you got to know the borrowers, either directly or indirectly. And fortunately for us, as you mentioned, our bankers have a lot of experience, so they come to us with clients that have been with them for 20, 30, sometimes 40 years in certain cases. After that, at the end of the day, whether it's a real estate deal or a commercial and industrial deal, you know, a regular commercial deal, comes down to, I agree with Rick, cash flow, their businesses. You do have to look at the value of the underlying collateral just in case. But we're cash flow lenders, whether it's a real estate deal or a business deal. And by the way, I mean, the relationship, you can't discount that. I know we keep talking about that, but it really shows you how important you are to the client, depending on how much they align themselves with you.
You know, here's an important comment. You know, Gino, you have a very interesting, especially in the real estate, one of a very interesting thing that you have a loan committee, besides your own people, of people who are in the industry. And we were talking prior to the show, you know, over the last 6 months, these people, some of them who are billionaires, have become exceptionally cautious. What do you see happening?
Yeah, our loan committee is made up of a number of very well-known people, some from the old real estate families, some others from various aspects of the real estate business, all long-time professionals, many with, you know, a lifetime in the business. And, you know, they see this as, you know, an environment that's fraught with danger, and that's probably worse than the previous downturn in 1990 and 1991.
So you know, that brings an interesting point of view. You know, and I'm going to probably do this in an article. There was a building that sold last week not really the building, the office condominium at 1540 Broadway, the Bertelsmann building sold for $355 million. Now, if you equivalate what the square footage is, it really sold for about $322 a square foot. Now, I did a little research into this, that the building, which was started in 1987 by Bruce Eichner and the VMS, went bankrupt, and it was the first prepackaged bankruptcy in 1992. Citibank also led it. You know, they always kept the situation of tough loans. And when Bertelsmann bought the building, they paid $122 million for the entire building at that time in 1992. Then subsequently the building was acquired by a joint venture of the Principal and Paramount organization, and they acquired it, and subsequently then over the years, because of the values increasing, as one would say, the retail was bought by Vornado for $260 million, and the office was bought by Equity Office for about $540 million. So basically the price was $880 million. Subsequently, 6 months later, then Macklow buys it for $950 million. But he didn't buy the retail, he bought the office component for $950 million. So now this this office component is sold for $355 million. Look at the reduction. Look at the situation. And there's really no upside in this building. So my question is, what do you think values have dropped over the last 6 months or year with regard to real estate values? I'll ask you, Kerm.
I'm hard-pressed to come up with a real number because it varies all over the place, but I would not be surprised to see, what, 20–30% decline?
Yeah, I think it depends on the product, and I think importantly, and you pointed out with this deal, it depends on the size. There's a lot of stuff that's under $20 million that's continuing to trade, but anything that requires large financing or large equity capital, those prices are huge.
I failed to say that the only way that this thing did trade was that there was seller financing. Right. Okay, this is the circumstance, and I think that brings out a valid point. I think big Mike Fascitelli from Vornado on my Money Summit and also on my show basically said big is bad. In today's world, large is dangerous. It's much better to do small deals. But that relates to another question with regard to values. Years ago, you know, like I said on this deal that happened in 1994, this deal, that was a club deal. It was Citibank and 14 Japanese lenders. What's happening with regard to banks participating? I mean, are you participating more when you're doing a loan?
Well, you know, as I said earlier, when we came in to grow our business in 2007, that was one of our strategies. You know, we'd like to be a part of good quality real estate deals, but diversify the risk on our balance sheet. So it was a good strategy at the time to take a piece of a larger deal. And, you know, the syndicated loan business, I think that's one of the reasons why you do it. It got out of hand because the syndicated loan business then became, well, let's see how much debt we can lay on, and let's see.
Right. It wasn't putting the team together. It was saying, can I get more money?
Exactly. You know,
it became a source of cheap growth.
Exactly. And
for the banks.
So it's exactly what you were saying earlier about getting away from the fundamentals. So we club out deals now. We actually do it on an ad hoc basis, call up lenders and say, are you interested in taking a piece of this deal? And we're actually now formalizing the process. We're actually getting other banks to sit down, come up with a term sheet that we all agree to. We've even invited a couple of developers into this process who want to lend money. And now we have a packaged term sheet that we go out and we put together the term sheet, and it's there. There's not a lot of negotiation. We have our parameters. It's sort of a roadmap. And that's what we're doing, and it's all about diversifying the risk on our balance sheet.
Are these blind for the participants?
No. Everybody knows exactly what's going on up front. And
it's transparent. It's the old-fashioned way.
Yeah.
Banks have always wanted to syndicate and lay off risk. Yeah. But we've come full circle back to the old-fashioned way where banks are selling to other banks and they know what they're buying into, and collectively they're dictating terms, as opposed to securitizations and CDOs where they're doing the same thing, but the buyers are less sophisticated. And
I mean, think about what happened at some point. The large lenders would go out and commit $500 million to a deal and sell it down later. that's not consistent with that process. You're already out there, you're, you know, half pregnant, so to speak. Now you got to back your way into and sell this debt. And there's no room to negotiate.
You know, for my audience, you know, this was the collateralized debt mortgage business, and I once had, twice on the show, I had a guy named Rob Verone, who they used to call Big Bob, Big Deal Verone.
Large loan Verone.
Okay, large Verone.
Large
loan Verone. And I said to him once, I said, how do you look at interest rates? He said, I don't really look at interest rates because I'm going to sell it in a period of time. So I said, basically, you're a bookmaker. And he said, yes, I'm a bookmaker. He says, I take the risk, and I think I'm going to find somebody to buy it, and I don't care.
And Michael, that's, in my mind, we're talking about back to basics. That, in my mind, is the inherent flaw, and what is one at the root, part of the root of all evil of what's going on right now, is you had banks out there making loans, quote unquote, bringing them onto their balance sheet for a very short period of time and selling the risk off. They weren't balance sheet lenders, and I agree with that. It's back to basics. You know, I think everybody here, we're balance sheet lenders. We're keeping the risk on our balance sheet. If something bad happens, it's our bad.
So now I ask the next question. I remember on shows in 2006, 2007, and I would have major developers, many people would know these developers, and once in a while I would say that word, personal guarantee or recourse, and they would look at me with this eye. How could you ever think of that? In today's market, what's your position on requiring the borrower to personally guarantee? Gino?
For any kind of a development deal, guarantee is absolutely mandatory and probably never should have gone away.
And David?
Well, on commercial deals, it never went away. You've always had, not commercial real estate, I mean, you ask...
Right, commerce and industry loans.
You ask the borrower to stand behind the business. They're asking us to stand behind the business.
And what about real estate?
On real estate, it depends. Once again, what the project is, what the deal is. Development deals, absolutely. On income-producing property, above a certain LTV, yeah, I would say yes.
Structured guarantees is what I like to call them.
Oh, I like the new term. What do you mean by structured guarantees?
That means that if you're into, you know, and I agree, development deals without question, but term debt and other types of facilities, you know, if you're trying to stay within a certain coverage ratio and you creep above that, I think the borrower should come in, guarantee that portion that takes you back down to a level in which you're comfortable with.
Got to have them. Got to have the guarantees.
So it doesn't matter
in all cases. But I want to address what you said about the C&I business and how guarantees were always required. A couple of years ago, there was an awful lot of pressure on for C&I business, and there was an awful lot of exculpated loans floating around out there, and there was so much competition that if you ask for the guarantee, they'll say, well,
they were walking away.
I'll go to the other bank, and you know what? They could. And they could find some crazy person who would do it, but that's all gone now. I mean, we will not go into a loan situation without personal guarantees.
Rick?
99% of our loans are full recourse, and the other 1% we have them guarantee it.
so you're 100%. But you know what? The real question is guarantees, recourse. How many times have over in your career and other careers, have you ever really called that guarantee? We found them valuable over the years, and they're really valuable in a case where you've got to keep them interested and really we call it in the canoe with us. It really motivates them to work with you on a job rather than threatening to dangle the keys. And we found them useful. We've had people write checks. But it really is premised on the idea that you've got to do your underwriting up front. If they've got huge contingent liabilities, or they're just a developer or a merchant builder, you're probably not going to collect much. If they've got large cash flowing or a number of large cash flowing assets and 1 or 2 development deals, which these are the people we lend to typically, you're likely to have a benefit from it.
Having the guarantees certainly keeps their interest level high.
It's psychological.
Yeah.
It really is.
It's not an exit strategy for repayment, that's for sure.
Well, sometimes it certainly can help.
Yeah, but it basically gets people to the table, and you negotiate. Sometimes people substitute other collateral for the guarantee, and people get
Speaking about other collateral, I have a dear friend who many of you have met, my friend from Progressive Credit Union, and basically what he does when he takes a loan, he tries to look at any other collateral that he could find. So if he's going to, he'll put a second on the house. He'll do anything. It's like my other friends who you know well, the people from Rosenthal and Rosenthal. They'll lend on art. They'll do anything, but they have more guarantees, except that they'll never guarantee their own line. They're great guys. But Do you look for additional collateral sometimes when you do a loan?
We do sometimes. We call that collateralizing the guarantee. It does not mean we don't require the guarantee, but in some circumstances where the guarantor is not that deep and not that strong, we will take additional collateral, and we call it collateralizing the guarantee, so it's quicker and easier to collect on that if you need to call on the guarantee and your primary collateral is not sufficient.
So, you know, I know that the five of you sitting here are all in business. You're still continuing to loan. You're loaning under higher requirements, better underwriting, and all the rest. You know, what's happening about, you know, the big names? Do you? I mean, you're in the market. You see them. Is Chase really lending? You know, are they really? I mean, Citi, from what I see, is not really lending. I think basically it's a nationalized bank.
Oh, I'm sorry, Greg. Go ahead.
No. I mean, I think that that's on a case-by-case basis. I think our world is shrinking, and you know, if you want to mention names, I don't think Citibank is too active right now. I think you know, Bank of America is, you know, selectively in transactions or leading transactions. Yeah, I think J.P. Morgan's CRA group is fairly you know, it's fairly active, more so than they haven't been balance sheet guys for a long time, and they have no more CMBS capability. So their private bank, you go to Chase, you either go to their private bank or you go to their CRA group.
So for the new kid in the town, I mean, personally, because of the new bank, this is a great time, I think, for you.
So personally, it's great. As far as being an American citizen, it's not great. You know, I think the reason that you asked the question to lead off the show is because there is a public perception that there isn't a lot of credit out there, and I think the reason for that is the larger banks in this country, especially here in the New York metro area, I can't comment on the rest of the country, is the vast majority of those banks are either not lending or lending on a very, very limited basis. Plus, you have coupled with that, which I'm sure we'll touch on, is the complete drying up of the securitization market. So those two factors onto themselves have caused the visibility of lack of credit out there. So we're taking advantage of it. We're hiring people from these institutions. We're taking their clients. And I think it's, from that standpoint, it's a great time to build an institution like ours.
I think you've hit on it there. The capability, the credit capability has shrunk dramatically in the country. You know, us little commercial bankers continue to chug along, but if you look at some of the statistics of the CMBS market, $246 billion in CMBS in 2007, $36 billion in 2008, a $200 billion decline in that market, and everybody says, well, the damn banks aren't lending.
This is the harder issue right here.
The harder issue. Yeah. I wish I had more time. I really would like to thank you. I think this has been really an interesting topic. I'd like to thank Gino Martocci, David Bagatelle, Greg Fierce, Kermit Dyke, and Rick Schuler for being here. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, HELMSLEY-SPEAR, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moinian Group.